Good morning. This is Mark Bowd of Real Estate Economics. Thank you for joining us for our most recent webinar. It is June 13th, Wednesday, and our topic for this morning will be the Southern California economic and housing market forecasts and opportunities that we see at Real Estate Economics. This will be a bit longer and more robust webinar than we've given in a while, and we're grateful for those of you who have joined us this morning. Let me actually begin by showing you the most recent patterns in terms of overall housing transactions throughout Southern California. If you're familiar with our website, you'll know that the blue dots shown on the map on the screen are traditional resales. Now, they include short sales. They represent about 64% of all transactions, at least during the month of April, our most recent month of data. New home builder closings are only 3%. Those are represented by the green dots. The red dots are foreclosures. That's about 10%. The foreclosure sales, or REO sales, from the lenders to a new owner represent about 21% of the mix. The fact that foreclosure sales are now more than double the rate of foreclosures is a good sign. It means that we're burning off distressed inventory at a fairly rapid rate throughout Southern California now. A little bit more information on distressed housing levels. This chart shows notices of default, foreclosures, and foreclosure sales over time, our 5-year forecast. If you accumulate the difference between foreclosures and foreclosure sales, you get a very good idea as to what inventory, distressed inventory, the banks are still holding. Our estimate is that about 33,000 distressed homes are still being held by lenders throughout Southern California. That's a very large level of supply, but much lower than where we were at the peak of 2008. We think it continues to decline, though it also continues to represent significant supply probably through 2014. By 2015, it moderates significantly. By 2016, it's closer to normal patterns. Our overall housing supply patterns on an annual basis are shown in this particular chart. This shows that overall supply will remain fairly contained, at least for the next few years. When you add on to that distressed inventory, you can see that overall supply with distressed inventory actually goes down through 2015, despite the fact that we'll be building more homes. We'll also be losing more distressed inventory, which will bring overall supply levels down through 2015. It's not till 2016, 2017 that we hit more normal patterns of supply. In terms of job growth, during the past 12 months, we've seen fairly decent job growth, at least during the past quarter, and we think that that continues at a gradual pace during the next 12 months. In terms of the types of jobs that we have in Southern California, the government is the second largest industry in California, or Southern California, followed by trade and transportation. That's a bit worrisome because obviously we continue to shed government jobs. This chart shows the amount of job loss or gain during the past 12 months. This is not necessarily a bad jobs report, but it does show that the government continues to leak jobs and will probably continue to do so. The private sector is actually doing fairly well, excepting manufacturing and construction. Now, manufacturing had actually gone positive in select areas of Southern California. It's hit a bit of a roadblock, and we think that can improves and begins to add jobs again during the latter half of year 2012. You can see what the overall job rate of growth was a year ago relative to what it is now. We were losing even more government jobs. This is where it was 2 years ago, and then of course when everything fell apart 3 years ago. So we have made definite progress in terms of job recovery. It's just that we're not quite firing on all pistons yet. You have to go all the way back to 2005, 2006 to find a real healthy report in terms of job growth. We think we'll see that again, but it'll be a year or more before we hit those levels that we experienced in 2005, 2006. Here's our overall forecast for the absolute level of jobs over the next 5 years. And then the annual change in jobs during the next 5 years. We think that this year will create about 78,000 jobs throughout Southern California, We think that that will eclipse 125,000 jobs being created during the next 5 years thereafter, which is, again, is a moderate to healthy pace of job growth in Southern California that we're predicting as we get a handle on our economy, on our debt, as the national economy recovers, as exports remain strong. We think that occurs. Now, if there is more trouble than we anticipate in Europe, then this could be lower. But as of now, we think that that can be contained. It's not going to be very exciting, and that they definitely will fall into deep recession. But these numbers account for that recession and assumes that they will not have more severe problems than they're currently facing now. In terms of overall unemployment, we see a continued decline thereafter from the very high level of about 10% currently, almost 11% currently. Our mortgage rate forecast for the next 5 years is an upward climb, but not really in earnest until about 2013, even 2014. Currently, rates are below 4%. That is highly abnormal. We think that the rates will remain low through 2012 and a large part of 2013 before really beginning to climb thereafter. By about 2017, 2018, we think we'll eclipse 6%, perhaps approach 7%, but those increases will lag economic growth on a national basis, which will continue to fuel new housing demand. In terms of the population throughout Southern California, you can see the bulge in population growth between 55 and 74. That means that we should be designing homes that accommodate this particular buyer profile. Now, there's still plenty of demand in the other age categories. It's just that most of the growth occurs above the age of 55. In terms of our price appreciation forecasts, I should mention that this isn't necessarily price appreciation. It's the change in median price of housing throughout Southern California. It's the best proxy that we have for price appreciation. And you can see that during 2012, it's about 1.5%, 2013, 3.1%. By the time we hit 2015, we eclipse 7%, then we'll fall back below 6% in 2017. This is our forecast. You may think that's aggressive, but when you apply this to actual median home prices throughout Southern California, we still don't even hit the level of pricing that we were at in 2005, 2006, 2007. So we're certainly not forecasting any new territory for Southern California. We've already been well above these prices during the bubble. We think that we'll slowly approach these prices, but we won't reach them until after 2017. In terms of our supply and demand model, you can see the green curve here represents our demand throughout Southern California. The blue curve is supply for housing throughout Southern California. The gap between the two charts is shown here. Tremendous oversupply, which began in 2008. It bottomed in 2010. Since then, we've begun to climb up toward equilibrium due to the creation of jobs, as well as the fact that we're really not building many homes. We don't expect to hit equilibrium until 2015, but there will be tightness in 2014. Now, despite the fact that we're currently oversupplied, we're also grossly undervalued. The green curve in this particular chart represents our measure of price support or affordability. The blue curve is where prices actually are, and the difference of the two represents either undervaluation or overvaluation. We think we are near the highest point in terms of undervaluation caused by very low mortgage rates and low prices. It's a very unstable position, and we think that it must fall back to equilibrium, which will occur as economic growth occurs with a combination of mortgage rate increases and price increases. If you like the numbers, the overall patterns in terms of underbuilding and overbuilding, undervaluation and overvaluation are shown in this particular chart, as well as our forecast for median home prices, housing supply, housing demand, and so on. So for Southern California, its economy is currently gaining jobs at about a 0.9% rate. The government is the one that's losing most jobs currently. Housing construction is increasing, but mainly due to apartment construction in the current cycle or in the current period. Housing affordability is near an all-time high. Despite continued high foreclosure activity, foreclosure sales remain much higher than foreclosures, and distressed housing is burning off fairly quickly. New home prices have risen slightly, but new home sales have slowed during the past 12 months. Year-over-year resale transactions are growing at about a 9% clip, and foreclosures dropped about 47% during the past 12 months. Current market improvements are still being driven by undervaluation. We haven't had enough job growth to cause an economic-driven cycle. We don't think that starts until we have regained all of the jobs that we lost during the recession. The mature market demand will become a driving force in the next cycle. Green technology offers a chance for new or retrofitted homes to capitalize on anticipated energy cost hikes. I didn't talk much about that, but we do feel that there is a place for new homes especially to capitalize on technology gains and separate themselves from the significant resale housing stock that remains in Southern California. Finally, we are going to invite you to take part in a beta test offered by Real Estate Economics. This will be a part of our website in future months at www.realestateeconomics.com/site value. If you go to that beta test, I'm going to give you the password to that is REE Forecast. Now, we're changing that password on occasion, and so if it does not work when you log on, simply contact either Judy Duell or Sandy Rivera, and they'd be happy to share with you the most recent password to that particular beta test. What this particular beta does is it gives a 5-year forecast of price appreciation at the zip code level. So you can go to any zip code throughout California, and it will show you what the average price has been, what it is currently, what the overall unit size average and price per square foot averages have been, as well as other pertinent metrics, and it will forecast that average price out for the next 5 years, giving you an idea as to how much prices will rise in a given zip code area during the next 5 years. We'll explain a bit more about what this particular product is and what it does, but those of you who would like to explore that, you're welcome to do so. We're grateful for you who have joined us during this webinar, and we hope you'll join us again. Take care.